wealth and build wealth. And also think big and dream bigger. Not even dream big, dream bigger today. This is what the shirt says. So, welcome. We're in the office here. I'm going to share a presentation with you. Today, what we want to touch on are the common investing mistakes to avoid and how to fix them. A lot of times you might be investing and you might feel defeated or discouraged because uh, you might not know some of these common mistakes. So today, we're going to tell you how to fix them. I'm going to share a presentation that I prepared for you, especially for you. So we're going to get into that. I'm going to share that. I see it. You see it. I'm here with you. All right. So these are going to be practical habits to build wealth without hype. This is part of the Big Chart Work series. This is going to be a guide to smarter investing. So I know we're going to do what is reality here today. The reality is the everyday costs are climbing. Interest rates remain elevated. Housing costs are very expensive. Groceries are expensive. Tariffs are impacting a lot of prices. And so also uh, the market volatility is going to create more uncertainty and emotional swings. And so these pressures are going to make investing feel like it's overwhelming, especially when headlines are screaming conflicting advice. You have headlines over here, headlines over there, and you're like, hey, I'm not about to invest my money in this. But the truth is that despite the noise, you can still build meaningful wealth. Success is not about predicting the next market move, as we like to do with our specialty tools, our innovative market intelligence tools that are really fantastic. Investor IQ, had to give it a plug. Please visit the website, check out the dashboard. But it's about establishing, being successful and building wealth for you and your family and your community is going to be about establishing a consistent discipline process. These small, repeatable actions are going to compound over time and they're going to give you significant results. And so, if you look at this video today, if you start today, and maybe you put a week on it and you say, hey, I'll rewatch them in a week, we'll get started. And then you revisit the video in 2, 3, and 5 year periods, you're definitely going to notice a difference. If you continue to work the plan that we're going to present, uh, you will reap the benefits. So again, this is not financial advice. This is education only. Um, but mistake number one is FOMO. And I will give you, as a professional trader, I've been in the market. We've been doing market things for 20 years. Plug out to the Wealth Builders Collective. Please join the community. There are day traders, swing traders, option traders. It's an incredible platform. And if you want to know what we talked about, there's an AI summary of the meeting um, right on our website on the main page. So FOMO, and I'm going to give you my example of what happened. Actually happened this week. FOMO and headline chasing. So the problem is buying whatever is hot based on social media hype or news alerts, and then panic selling when fear dominates headlines. So this reactive approach is going to destroy your returns and increase your stress. It is stressful to be in the market. It takes up mind capacity, mental capacity to be in the market, and you're sitting on a loss. And that's why when we go through the videos, we've built these tools for you to get in at certain price points. So hopefully you can mitigate some of that loss if the trade goes against you. We've got videos on this. We're going to produce more, but we'll get into that. So the fix is you want to pre-write your rules before emotions take over. Only buy stocks or ETFs already on your watch list at predetermined price levels. So that means that you've added it to a watch list in one of your apps, your Robinhood, your Cash App, your Fidelity, your Charles Schwab. Um, after you added it to the watch list, you're just watching the price action. If it goes up, don't say, oh man, I should have got in there. It will come back down. And sometimes you'll notice, hey, it's been hovering around this $300 price. We'll take McDonald's and we can take a look at that. I know it's been between like 300 and 315. I'm not sure what it is today, but it's been like 300 to 350. You'll notice what the price action is on that security. So then you'll be able to determine a good entry price. Now, if you join the wealth builders or if you do any kind of charting, charting is going to give you an even better identification of a price to get into that stock or ETF. If you're just starting out, you want to save, you're not really interested in trading like that. Uh, just learning a little bit of support resistance. We'll cover a video there. It will definitely do wonders for you. So pre-write your rules before emotions take over. Only buy stocks or ETFs already on your watch list at predetermined price levels. Create discipline through preparation, not willpower. So just don't jump in. Hey, GameStop is moving. I'm going to jump in and try to get some gains. I tell you, once you decide to jump in, that thing goes against you. Happened to me with gold. Gold has given us about a 40% return this year. I said, man, I got to get some of this. This thing just keeps going up. Got in. It pulled back 4 or 5% yesterday. And I said, man, it would happen, right? Would happen to me. But these are the things that happen, especially when you don't pre-plan a price level to get into. Had I pre-planned that, I probably could have gotten in at a better price. Action tool. So what you want to do exactly is we want to use limit orders at technical support levels or pullback zones. And that's going to remove emotion and ensure that you buy at a planned price. I jumped in the gold. I said, let me just get some, and then I'll average into it. I don't know how far gold is going to fall. It's up 40%. That is incredible for stock market securities. This is not Bitcoin that goes up 1,000%. Like 40% is significant. There are stocks that are over 100%. For example, Celsius Holdings and Palantir. I believe that might be over 100%. Maybe I have to evaluate it, but I know Celsius Holdings is definitely over 100% return. So let's not FOMO. Let's create a plan to recap. Let's write down, let's monitor and surveillance. We're doing ops, counter ops, we're going to surveil the stock and just see what the price swings are. Once we get those price swings, we can and look at the chart. We've got chart videos, we've got resources that you can use to understand chart price action. You'll get an entry price. You write that entry price down, you set a limit order. Once that price hits, it automatically picks up your security at that price. Okay? Next, sorry I beat that up a little bit. Mistake number 2, no plan for entries and exits, which we kind of just covered. The problem is entering positions without clear reasoning or exit strategy. It's a dangerous, I'll figure it out later mindset, and it leads to frozen decision making when markets do move. We can take some examples of this. The fix is to maintain a simple trade journal. So you just want to document, hey, this is my entry reason. I believe that this is a good price, or it's sitting on the support level. It's sitting on parallel support. It's 2 price levels below. I think it'll pull back. Whatever your reason is, then you want to set the price target. Then you want to do your maximum risk tolerance. So this is setting a stop loss. I had to do a whole re-educational on a stop loss, some old black and white videos, but they were very powerful videos. You have to have a stop loss. The name of this is risk management and capital preservation. You want to preserve your capital. You don't want to just lose. And this, if you didn't know what this is a stop loss. It's an order type. So the limit order is an order type. Most people, when they want to buy something, they do market orders. But you can pull down your market order and you'll see it'll say order type. Most of the time it's default at market. That means you're going to get the market rate. One thing my brother told me, everything is negotiable. And if you watch price action, you know you can get a better price. And so you set the order type as limit order. Once you get in, once that triggers, and now you have the security in your portfolio, you go into there. Once you have it, you set a stop loss because we want to limit how much we lose on that stock or security. Um, and that's going to be part of your risk tolerance. So if the security is very volatile, keep in mind, so let's say it swings 15% per day, you're going to need at least a 20% stop loss if you're comfortable with that. Most of the time, high flyer stocks, five to $20. I'm gonna say really 5 to 15, 5 to 10, $5 to $10 stocks probably are gonna fluctuate more than 10%. So you have like BBAI, you've got Bumble, uh, you've got a lot of stocks that will fluctuate higher than a normal level. And so if that's not part of your risk plan or your strategy, you don't get into that trade. You don't get into it. And your intended time horizon. How long do I want to be in this trade? If you're a day trader, they want to be in for a day, maybe two, maybe three, but they try to get in and out. You're a swing trader. I equate that to maybe about 3 weeks to uh, maybe 6 weeks. Um, a nice time period for the stock to actually make a nice move. If you're a buy and hold trader, that means you're setting it and forget it. Okay. We can go into my Webull account. I set it and forget it. I just put a small amount in there just to see how Webull works. But I set it and forget it. I got Palantir, I got Nvidia, I got AGNC, I got I think Uber, and I might have one more thing. And it's like a 50% return. Um, I set it and forget it. And if you look at Palantir, if you look at Nvidia, those things have performed very well. Uber, AGNC is the REIT, so I wanted that dividend. But it like I said, man, I shouldn't even be a swing trader. I should be a buy and hold trader and just set it and forget it. Actually, and if we did it with gold or international stocks, you just have to know where the opportunity is and what prices are good prices, and you can be an excellent buy and hold trader. Okay, so our journal template is going to be the entry date and price, why I'm buying this, which is your thesis, your target exit price, your stop loss level, and your time horizon. So we beat that up a little bit. I'm going to try to get you out of here. I get excited. Mistake number three, not using dollar cost averaging. This is called DCA. If you heard it, it's DCAing in or DCA, you can DCA out. If you are sitting on a profit, you can scale out rather. The problem. So waiting endlessly for the perfect entry price. Markets rarely cooperate with our time preferences. That's going to leave cash idle while opportunities pass. And it's okay. Cash is a position. But if you've confirmed the market is in an uptrend, the sector is in an uptrend. So let's say the tech sector is in an uptrend. The NASDAQ is going up because that's like a tech heavy index. NASDAQ is doing well. Tech sector is doing well. Okay, NVIDIA should do well. Let's get NVIDIA. Is it a good price? Did it hit my price? And so sometimes it can get close to your price. You don't want to be lenient if you want to get into it. If you're not really concerned about getting into it, you can set a price, and if it hits, it hits. Um, and so the fix right here is we're talking about dollar cost averaging. Sometimes I get into the swing trader mode, but if we're buying and holding, and you want to automate small recurring purchases. So, for example, I am doing small recurring purchases on Bitcoin every week, just buying small amounts. You can do it weekly, monthly, bi-weekly into core ETFs. ETFs are exchange traded funds. What this is you can get an ETF basically on anything. You can get REITs are sort of an ETF. They just hold real estate. Um, You can have biotech ETFs, you have material ETFs, you have gold ETFs, you have inverse ETFs. Check out the inverse ETF video. It's how to make money when the market reverses. You can put an inverse on. So check that video out. But back to dollar cost averaging, automate small recurring purchases, weekly or monthly, into core ETFs. You can just go to Google what are the best ETFs. Vanguard is usually pretty good with low fees. Um, iShares is pretty good. So you would just want to Google what are the best ETFs. There's some popular symbols that'll show up. Do a little research, of course, and jump into that ETF. You'll be very surprised. The market has done well, so well over time. This is going to remove timing anxiety that builds positions systematically, regardless of short-term volatility. So get those ETFs. But when you get into those stocks, you can set a certain price that you say, hey, if it follows this price, I get into it. But if it don't, I'm in my ETFs automated, not a problem. Pro tip, use a two-tranche approach. So schedule DCA for consistency plus opportunistic ads during meaningful pullbacks. So let's say you're putting $10 a weekend or $10 a month. Come on, people, you can invest. $10 a month. You buy Apple phones for $1,000. Okay, I'm just asking you. Put $10 in the stock market for your future. Try it out. So that means we've got our $10 a month going. And then once that $10 a month is automated, boom, we're not even thinking about it. We might get a little extra. Let's say our side hustle, we got a bonus, we might get a little extra money. Let's put a little bit more in there, one-time investment. Or, so I'm adding to this. That's one opportunity. The next opportunity is, let's say we don't have that extra cash, we're just doing our $10 monthly, but we see a market pullback. It's called an investment. Okay. You have to invest in yourself. And you do. If you're going to college, you've invested in yourself. If you're learning a trade, you've invested in yourself. If you're spending time studying, you are spending time, which is an investment in yourself to study. And so invest. I know it's monetary, you might have to dig, but you want to invest in good opportunities. You get a 10 to 15% correction, you picking stuff up on the low. Okay. 20% correction happened earlier this year. So we've got a video for that. Corrections and market pullbacks. Check that out. But check out when that happened. It was earlier this year. Check out what those prices were on your Apple, your McDonald's, your Nike, anything that you have in your home that you're buying, your Monster beverage, whatever you have over there, you can pretty much invest in. So just look around. Dell Computer, Hewlett Packard, we've got it. They've got it in the stock market. You can invest $10. You might can do $1. I don't know what they'll do, but check out Robinhood, check out Cash App, check out Fidelity, check out Charles Schwab, check out Webull, check out not Trading View, Interactive Brokers. These are all places that you can set up an account and invest money. Mistake number 4, over trading your long-term portfolio. So what we want to do is our core holding, 80 to 90% allocation. You can adjust this the better and more comfortable that you feel. But this 80, 90% allocation is going to be for broad market ETFs, a long-term buy and hold, stocks, minimal trading, and things that are tax efficient. Investments that are tax efficient, such as municipal bonds. I believe you don't have to pay taxes on that. So your Explore portfolio, 10 to 20% allocation. So you want to do tactical sector plays, something that you hear. You say, hey, Prime Day is coming up. Usually, I'm not saying this, but this is just a saying, but usually Amazon pops before Prime Day. Okay, let's put our 10 to 20% allocation. Let's do a tactical sector play. Okay, individual stocks. So tactical sector play, that could be healthcare, consumer durables, consumer staples. I'm not sure where Amazon falls. It's techie with AWS, and then it's got, basically people buy Amazon every day. I consider it a consumer durable as well. Shorter time horizons, and then this is your learning laboratory. This is your watch list, your journaling. This is where you're creating your strategy. People have support resistance strategies. People have option strategies. I've got a cup and handle pattern strategy, which is a momentum strategy. There are tons of strategies, so you just kind of gravitate to what you think is good. I know people on our Wealth Builders Collective, they have strategies where they bet against the market, something going down, because they might hear some news might come out and they'll say, hey, I'm going to short that because the news came out. It was not good. And so whatever your strategy is, you must fine tune it. I'm actually fine tuning my strategy today. Because I entered a position without confirming the volatility of that position. And so that's a mistake. That's what I did. I don't know if that's in these slides, but confirm the volatility of the position. You're a day trader, swing trader, or if you are a buy and hold trader, things like Tesla will fluctuate. They have high volatility. So if you can't stand to look at something that's down a lot prior to a move up, that's something that you might not you want to steer away from. Mistake number 5, poor diversification or over concentration. That means we are so heavy in tech. Everything is tech. And if you were in tech today, you got hit. Last Friday, probably got hit. And so we want to make sure we have a nice, healthy mix. There are ETFs that mimic indexes. And so indexes have gone up at least between 7 and 12% on average over time. I think it was very high last year. We're at about a 13 to 16% return this year. Last year, I think it was around 20%. These are phenomenal returns that are being had. Gold, 40%. And so international ETFs up 20%. These are real numbers, people. This is what you could be having. You just want to get in at a good price. So mistake number 5, poor diversification or overconcentration. Portfolios dominated by one sector, one theme. Let's say you're just investing in AI. If AI has a bad day, a bad week, bad 2 weeks, your portfolio is going to get hit. Or individual holding create unnecessary risk. When that area falters, your entire portfolio suffers disproportionately. Okay, so the fix is our core satellite strategy. And I might have to go back to the other one. I don't know if we did the fix. But broad market ETF, we want to give a 60 to 80% allocation covering the total US or global stock market. Then we want to, that's going to provide instant diversification across hundreds or thousands of companies. Then we want satellite positions. So these limited tactical allocations, 20 to 40% to specific sectors. So REITs, international exposure, or factor strategies that align with your conviction. There are weed and marijuana stocks, there are hospital stocks, there are jail stocks, there are anything your heart desires. There are farming stocks. There are farming equipment stocks, Deere, if you've heard of that. It's a vast universe. You can invest in Marshalls, TJ Maxx, Costco, Walmart, which owns Sam's Club. It's a vast universe of opportunity. I'm going to go right back because I want to go down here. Frequent switching triggers, unnecessary taxes, transaction fees, and emotional stress. So you want to separate your portfolios by purpose to avoid turning long-term investments into short-term trades. And so if you have an AI thesis, you don't want it so heavy in AI, but you do want that AI, as that 20% of your 100% portfolio. You can do the other 20% industrials, materials, gold, boom. You can do the other 20% international. You can do the other 20% just your stock picks. Maybe the Mag 8, Amazon, Google, Microsoft, boom. even though you hit that other tech part over here. But maybe we do some consumer staples, right? These are going to be your everyday needs, your Procter and Gamble, Johnson and Johnson, your probably I'm going to put Amazon in there, even though it's a tech company, but if people use that every day. Your Walmarts, where people shop it every day. Um, your Ford, your GM, the necessities to live life. So you can put it over there. There's many opportunities. Just make sure you have good diversification. I'm gonna go right back here, make sure we did our fix. We did the fix there. All right. I want to give you the whole presentation. I don't want to cheat you. You came, so I'm gonna give it to you. Mistake number 6, ignoring costs and hidden frictions. We definitely don't want to do that. So we have to watch out. This is important. Expense ratios, annual fund management fees, compound over decades. What is the annual fund management fee? The fund management fee is what the fund manager, if I'm over here and you invested in a fund or ETF, there are expense ratios. And so that expense ratio is for the administration, the management of that portfolio. When you are a fund manager, you are buying chunks of stocks and you're selling chunks of stocks. You're managing a portfolio, you're managing that risk, you're entering and exiting accordingly so that you can give your shareholders a good return. You pay for that. That's what you're paying for. A 0.05% ETF versus a 0.75% mutual fund means thousands in lifetime savings. So this is the key here. Management fees compound over decades. If you have a management fee compounding over decades, it's going to cost you thousands in lifetime savings. It may cost you. Trading costs. There's something called bid-ask spreads, option premiums, and transaction fees. They are going to add up with frequent trading. So I think Fidelity, they charge 65 cents for an option. Each trade must overcome these frictions to profit. So when you're calculating your option, it's not only going to be, the premium that you paid plus um, the price. It's also going to be the fee that you need to make up for. So tax inefficiency. Short-term capital gains are taxed at a higher rate than higher ordinary income rates. So you want to use tax-advantaged accounts, IRA, 401k, for active trading and long-term holds. Action step. So what I want you all to do is you want to calculate your all-in cost before any purchase. That means you're taking out the expense ratio. You might not do this, but this is what you should do. Okay. You're calculating the cost for that trade. You want to compare the total expense ratios, trading fees, and tax implications across similar investments. So a good search on Google or ChatGPT is you say, hey, give me the ETF with the lowest expense ratio that is a great performer over time. And it'll give that to you. The foundation. So first, before we implement any of these strategies, which we can still do the automated strategy, but we definitely want to make sure that we have an emergency fund. Mistake number 7 is that there's no buffer. We are forced to sell. So life emergencies happen. When people say that life has started to life, it's emergency. So medical bills, jobs, urgent repairs, they're going to force you to sell investments at the speed of lightning. If, and they happen at the worst possible moment, often during market downturns. And so the fix for this is we don't want to sell our investments to make up for an emergency. We want to have 3 to 6 months of essential expenses in accessible savings before aggressively investing. Start with micro saves and automate weekly transfers. So this buffer is going to protect your investment timeline and eliminate panic selling. And so to build that if you need to start with the emergency savings, you can do the same method, $10 weekly, $10 monthly, bi-weekly into a savings account. Build up that. It'll take a while, but it adds up. Trust me. And then you get that 3 to 6 months. Then you can say, hey, I don't miss that $10. I'll do another 10 for my investment account, you know. Um, so you can do it like that. But that is how you want to do it. And it's going to protect you in the end. We're here to build wealth and protect you. Your next steps are going to take action today. Today. You've been putting this off for so long. And if you haven't, I'm glad you've been investing. I'm glad you've been watching and following. Kudos to you. You are definitely going to start building wealth if you're not building wealth already. You want to download the resource. We've got this free guide. It's get the free common mistakes checklist plus trade journal templates at Biddles Group. We actually demonstrated the trade journal template, but I can show you what I do in Webull. You want to set up these systems tonight. If you don't do it tonight, please do it tomorrow or this week or this weekend. Got to be this week, and keep learning. So set up those systems. You want to establish or at least create a plan and say, hey, how much am I going to dollar cost average into this? What do I want to invest in? And then create your first journal entry. 30 minutes is going to change everything. Just 30 minutes. Keep learning. Subscribe to Big Chart Work or this channel, Biddles Group channel, for weekly skill building. Big Chart Work is just a series of charting and how we do our trades and how we execute our strategy here. So we'll show you a few resources before we get out of here. And I thank you for hanging with me this long. Process is going to be predictions. So visit Big Chart Work, those series of videos, common mistakes checklist. I do not know if I have it up, but I'll show you what that looks like. Actually, it's going to be here. What to do. Give me a second. Sorry, people. After the day. So this is the guide. You'll go right to the website. You'll download this. This is everything that we've talked about today. It gives you a nice little framework. I'll also show you some of the other guides that we have worked on. We've got a cup and handle playbook. You can see that there if you want to go download that chart work cup and handle playbook. I'm actually going to refine this. We've got to go through every step and we're going to refine this because I just got some nuggets today. So we're going to refine that, but it's definitely a good blueprint. You'll tailor it according to how you want to tailor it. And then we have our chart work trading blueprint. Yeah, look at that. Beautiful. You can go download all of these. Swing Traders Rulebook for consistent profits. This has done me very well. I'm going to post my profits. I'm at an above 20% return on the corporate brokerage account. So we've been doing well. We've been beating the market. Now, these last 2 months, but we have been beating the market, and I will post that at the end of the year on the corporate account. And so these are just going to be some basic things, basic rules for you to follow. You want the guide, you can pause the video, or you can just go download the guide for yourself. This is our Investor IQ dashboard. We've got the Cup Finder worksheet. And so these should be cup patterns. Not all of them are cup patterns based on a formula. You want to choose something that's got good momentum. And we've got multiple pages that are just going to help you execute trades, find good prices, understand where things are from support resistance levels, how volatile the stock is. All of that information is here. I failed. I actually show you an example. I went into, I have to confirm my entries. So if I see something that looks good, great. Okay. We got to make sure that it's above the moving average. We got to make sure that, and we got to look at the weekly moving average. This had a 14% ATR, average true range, which means this trades about $1.74 per day. This is a $11.67 stock. So that's more than 10% that this is trading per day. It's trading at 14%. It can fluctuate. So if you put a 5% stop on here, bounced out on a daily basis, you have to be comfortable with about a 20% stop so you don't get bounced out of this if you trade it. I set a low limit for it. The cup pattern looked really good. We'll go to the cup pattern. I'll show you that. You see that cup right there? Boom. And so we're in the parallel channel. So I drew that parallel channel. We've got a a range right here. I can lower it or higher it, but either or, this price has actually jumped back in the range. This is the crucial point. We need to stop here. Anything less than that, have to get out of the trade. Trade is going against us. Excuse me. But one of my low limit orders hit. And so this is a crucial point. Gold, IAUM. I'm going to show you everything we talked about. Huge pullback. Look, it looks like it's up to date though. So that's a little good. A little good. Huge pullback here. Gold is up 150% in 3 years. In 1 year, this particular stock is up 49%. I told you gold was up 40%. This one is up 49%. 55% year to date. Year to date is going to be January to today's date. 55%. Ridiculous. I want to say this is Europe right here. Europe. Year to date, 19%. We'll do China. These are internationals right here. Year to date, 32%. We just sat over here in internationals doing the US market is doing 13 and 16%. Everything I've showed you, this gold, this international, Europe, China, they're doing double the numbers. You know what I'm saying? This is why the diversification is crucial. You don't just want to be in the US. You want to do some commodities, some bonds. All of this is going to help protect you in the long run. So this is what we use. You can come right here, check that volatility. If nothing else, you want to get into a trade, check that volatility right on page 5 of 7. But we've got all of these pages. Feel free. We've got the live market data. We've got a chart from TradingView that you can use along with fresh news. Netflix stock has dropped. I know Tesla, their stock dropped. Beyond Meat was skyrocketing today, going crazy. I guess it was a short squeeze. You've got the indexes, futures, bonds, forex, active, gainers, losers. So the gainers today, Ford, Nvidia, well, active, Bit Farms. Gainers, let's see what gained today. Armada Pharmaceuticals, some low price stocks here. Then let's see what's the big losers today. Nothing I recognize. So these are some of the benefits. And then if you want to watch the Wealth Builders video, the AI summary of our meeting last week, this is October 11th. You got access right here to that. Please visit the website. Tell me if you like it. Tell me if you don't. Tell me if, we want to refine this because we need UAT, user acceptance testing. So please be a user, accept, test, help us make this work really well for you. Because it works good for us, but I know it needs a little refinement. So thank you so much. I know I've kept you way too long today. This is definitely probably one of the longest videos, but I appreciate you. I appreciate your time. And remember to avoid those investing mistakes. Signing off here. Thank you so much at Biddles Group. All right, bye.